Hello family, Sir here. And if you're interested in buying a home and are interested in this new program that Bank of America offers, this is the video for you. The program in question that Bank of America just came out with is the Community Affordable Loan Solution. In this video, we are going to break down this loan program, which allows for no down payment, almost no closing cost, no mortgage insurance, and no minimum credit score. Real quick, let me tell you what's exactly going to happen in this video. I'm going to give you an overview of the program. I'm going to give an in-depth breakdown of the program. And then I'm going to talk about the pros and cons. And lastly, I'm going to talk about why I was initially very conflicted regarding this program and if I thought it was beneficial to my community, people that look like me. So please stick around if you want a full breakdown, in-depth breakdown of this program. And there will be timestamps in the description so you can jump around a little bit. Now, for those of you who do not know me and are new to the channel, my name is Sir Ashley. I am a realtor and investor here in the Charlotte area, but I have team members throughout the Carolinas. And if this is your first time watching, welcome. I appreciate you being here. And if you've watched before and have come back, thank you for rocking with me. And a quick reminder, if you get any value out of this video, please go ahead, hit that like button, and also consider subscribing to the channel and sharing this video with friends and colleagues. Now let's get back into the topic of this video. Quick overview before we move on. All right, so here we are on the computer. And yes, this is the Community Affordable Loan Solution by Bank of America. And it offers zero down payment, almost zero closing cost, no PMI, which is private mortgage insurance, and no minimum credit score. This program is based on the property location, and it has to be, right now, it's a test program in 5 locations: LA, Miami, Dallas, Detroit, and the greater Charlotte area. Now, in the greater Charlotte area, for the North Carolina portion, counties that qualify are the following counties: Anson County, Cabarrus County, Gaston County, Iredell County, Union County, Lincoln County, and of course, Mecklenburg County, where Charlotte is located. And in the South Carolina portion of the greater Charlotte area, you have York County, Lancaster County, and Chester County. Now, I believe Rowan County is in there, but I'm not 100% positive. As I was talking to the mortgage loan officer for Bank of America yesterday, he wasn't quite sure. So if you are in one of those counties and the census tract is over 50% Black or Hispanic, then the property will qualify for this program. Now, this has been promoted throughout social media for the past couple days as a loan program just for minorities. No, anybody can apply for this loan. Anybody can get approved for this loan, but the home has to be in a certain location and you have to have a qualifying income, which we will get into depth a little later on. But just to dispel of that fallacy or that falsehood, it is not just for minorities. Now moving on to the income limits. The income limit to apply for the loan is $120,000 in the greater Charlotte area. Now the other locations, Miami, LA, yes, you probably will have a higher income limit. And Detroit, you might have a little lower income limit. And Dallas, I'm not sure. But if you have any questions and you live in those other areas other than the greater Charlotte area, please feel free to still reach out and I will try to connect you with somebody in your location that can help you and assist you in this process. We're going to talk about the purpose of the program, the breakdown of the program, and the pros and cons of this Community Affordable Loan Program by Bank of America. Now, the purpose of the program is to increase home ownership throughout minority communities. Now, I will get in depth later in the video when I'm talking about the pros and cons, when I talk about historical aspects and what this means and how minority communities have been disenfranchised or purposefully withheld or not allowed to own properties. But that's further into the video. Right now, we're just going to talk about the purpose of the program, and that's to increase home ownership in minority communities. Now, the home ownership rates across the races are as follows. About 72% of white Americans own a home, 61% of Asian Americans own a home, about 51% of Hispanics own a home, and 43% of African Americans or blacks own a home. That is the demographic breakdown of home ownership right here in the United States as of the last census. Now, this program is designed to increase home ownership in minority communities. So the breakdown of this program is as follows. It uses credit guidelines based on factors such as timely rent, utility bills. It could be memberships, your phone bill, or your auto insurance payments. There is no required mortgage insurance and no minimum credit score. Again, I said your eligibility is based on income and home location, and prospective buyers must complete a home buyer certification course. So the breakdown of the program, the general outline, is not very complicated at all. But if you follow me, you know that the devil is in the details, and I like to get granular with it. So let's jump into the details. Detail number 1, it is not dependent on somebody's race. We touched on that just a little while ago. Anybody can be approved and use this loan. It depends on your income and the home location. Home location is the biggest component regarding eligibility for this loan. Now, I said it depends on the home location. The home has to be located in a census tract that has 50% or greater minority population, Black or Latino Hispanic population. It will be eligible for this program. All right, so we talked about the location of the property. Now let's talk about income. Your income for the greater Charlotte area cannot be more than about $100,000 to $125,000 per year. Now, I was on a very lengthy phone call with a mortgage loan officer from Bank of America just yesterday, and I asked them all the questions and scenarios that I could think of that my clients or you all may have when I present it to you. So let's jump into it. The income requirement is for one person. It does not include the household. So if it's a married couple, one person, husband or wife, can apply for the loan if your income meets that threshold of being under 125 or 120,000. So they will consider applicants on the individual basis, even if you are a married couple. That is absolutely huge because I know a lot of the programs in the past combine the joint income of the household to see if you qualify and meet the income threshold. This you can apply using just one individual in the household, and if that person is under the income limits, then you will qualify. Now, the next thing I want you to consider when it comes to income is your debt to income ratio. Remember, when you're applying for a home loan, lenders look at your debt to income ratio. And in this scenario, for this program, you can have up to a 50% debt to income ratio. Now, that's higher than the normal debt to income ratio for conventional loans and FHA loans. So you're able to have more debt. But remember, the more debt you have, the lesser your property price that you can afford. So let's say you are a married couple and you want to take part in this program, but both of your combined incomes is over $120,000. One person can apply and still be approved for that loan. So let's say the husband makes $80,000, $90,000, but the husband also has vehicles in his name and different credit cards in his name, and all that debt in his name negatively impacts his debt to income ratio. My recommendation to you in this situation is see if you put the debt into the person's name who's not going to be applying for this mortgage, where we can free up the husband to where he has no debt when they go to look at his debt to income ratio. Hopefully that was clear, but let me give you a quick example. If I and my wife had a car and the car payment was $700 a month, but it was in both of our names, well, that $700 a month is impacting how much I can get qualified for a home. So we'll have to see if I can refinance or if my wife can refinance the car in her name completely to where I am off of that debt. And then when the banker or the lender is looking at my debt to income ratio, it's not showing that debt. And that means the price of the home in which I can get approved for is significantly higher. Quick overview before we move on. The income limit for the greater Charlotte area is $120,000. Now, if you live in the other areas, let's say LA or Miami, yes, your income limit will probably be higher than $120,000. And if you live in Detroit, I'm thinking it might be a little lower than $120,000. Dallas, I am not sure, but please leave a comment below or reach out to us and we will try to connect you with a local specialist or realtor in that area that can assist you in this journey. And then the second thing is your debt to income ratio cannot be more than 50%. So if you have all of this reoccurring debt, monthly debt, your car payment, student loans, that will impact how much you can get approved for a home loan. Now let's look at credit. No, you do not need a minimum credit score, but they do evaluate your credit. Now, what separates this program from the other programs that are offered that looks at non-traditional sources of credit is that in the past, prior rent had to be one of the non-traditional qualifiers for credit. Now, as it pertains to rent, they're going to look at the past 2 years. However, if you say you've been living rent-free for the past 2 years, they're going to take your word for it, but they're also going to do a snapshot of the past 2 months' bank statements. And if they see that something has been coming out of your bank account that looks like rent over the past 2 months, that's going to cause them to dig a little deeper. And then they're going to look and see, okay, well, has this person been paying consistently and on time their rental payments for the past 2 years? So on your application, when it asks about rental history, and if you say, hey, I've been living rent-free for the past 2 years, make sure that your bank statements corroborate that. So another thing as it pertains to credit, because they do not require that you show that you've been making rental payments for the past 2 years, they do require that you have at least 4 months reserves in the bank account. So if your mortgage or your soon-to-be mortgage is going to be, let's say, $2,000 a month, well, they're going to require that you have in a bank account reserved $8,000. So that is the offset. That's the granular stuff that a lot of these people are not telling you about that you need to make sure you have when you apply for this loan. Also, talking about credit, there is no minimum score requirement. Let's say you have a 515 or a 550, that does not preclude you from getting approved or being eligible for this loan program. Now, what they will look at is your account types and credit types. Once they pull your credit, if they see derogatory credit on your credit report, they're going to ask questions. Hey, what happened here? And how have you rectified it so it will not happen again? Another question I asked them was regarding medical bills. I've seen that medical bills has been a huge impediment from getting people qualified for a home loan. Well, in this program, they do not consider medical bills or medical charge-offs. You could have potentially $100,000 worth of medical charge-offs that will not be used against you negatively in this loan program. So that's a huge positive. But this next point is very key and very crucial. If you had a car repossessed or a credit card charge-off, they will be looking at that. And if that amount is not less than $1,000, you will have to pay that difference in order to be qualified for this loan program. So hypothetical, let's say you had a car repossessed and the charge-off was $7,000. Well, that will disqualify you from getting approved for this program until you got it paid down to less than $1,000. Or if you had a credit card that had got charged off and the balance was, let's say, $3,000. Well, again, that will disqualify you. Again, they're not looking at your credit score, but they're looking at charge-offs because, again, they have to look at your past to be able to see your present and look into the future. So in the past, if you had a charge-off or a car repossessed, that doesn't make them feel comfortable in loaning you money. So they want to make sure that you are going to pay your debts and you pay it down to where it's less than $1,000 left, and then you can get approved for this loan program. That is one of the fine details that a lot of people have been overlooking when they share this program with you. Now, for further clarification, the $1,000 is an aggregate. So let's say you had a car repossessed and you had a credit card charge off. Well, you have to have both of those together have to be less than $1,000, not just the car balance and not just the card balance. Total charge-offs and everything cannot be more than $1,000. The next thing they look at regarding credit is they make sure you have at least 3 trade lines and they look at the 12-month history. They want those 3 trade lines to show during the 12-month period that you've made consistent and timely payments on those 3 accounts. Now, again, those accounts could be your car note, your phone bill, your auto insurance, or your rent. All right, doubling back regarding income, they do make sure you have at least a 2-year work history unless you were in school. Now, if you were in school, you do not have to have a 2-year work history. You just have to prove that you were in school. But otherwise, they do want a 2-year work history in the same field as you are presently in as you apply for the loan. Now let's move on to the next part of this program, which is actually the first part, and that is the home buyer education. Now, the home buyer education has to be the first thing you do. You have to complete it before they will issue you a pre-qualification or a pre-approval. Now, the amount of education one needs or how long it takes is unknown. It really depends on the individual. If there is an individual who has like a 550 credit score, but it's not because they're delinquent on anything or have any past due balances or charge-offs, it's just the fact that they have not established their credit, well, their situation is going to be much different, and they're going to be able to complete this home buyer education process much faster as opposed to someone who has a 500 credit score, but they're delinquent on some things, they have high credit card balances, or they may have some charge-offs. That person will have to go through a more thorough home buyer education and certification class. So the education portion really is person specific. There's not a one size fits all. So if you're someone with good credit, you will not have a problem as far as time-wise to complete that home buyer education requirement because it won't take you long to do so. Now, the home buying class or education is a one-on-one with a HUD-approved sponsor. Knowing that it's going to be one-on-one and knowing that there are going to be, most likely, a lot of people applying for this program, the faster you get in, the higher on the totem pole in which you can have an appointment with that one-on-one person. Because remember, you have to complete that education requirement before they will even issue you a pre-qualification and a pre-approval. And another question I get is concerning interest rates. Now, I'm not trying to hide this from you. The interest rates are going to be higher than your normal FHA or conventional loan because these loans are much riskier for the lender. Because you have a high loan to value ratio for the home and the lender is not looking at traditional credit sources. So this makes the loan more riskier. And if a loan is more riskier, they're going to charge the borrower more money to take advantage of these loans. Now let's talk about the pros and cons of this program. Now, pros are it is allowing people that would otherwise not be able or have a challenge to get approved, be able to qualify for a home loan. It allows them to get up to $10,000, 3% or up to $10,000 in down payment. It allows for them to not have to pay the majority of closing costs. You will have to pay the reoccurring closing costs, which means the taxes and insurance. Another pro is that there's no minimum credit score requirement. Now let's talk about the cons of this program and why, when I first heard about this program, I was completely turned off by it. And then I was up last night thinking about it and was jostling between whether I was for it or against it. And truth be told, it doesn't matter what I think. You have to determine for you if it is a good opportunity for you and if you should proceed with it. But I will tell you the cons and why I was initially very hesitant regarding this program. For one, the program is only available in certain locations, meaning the home itself has to be in a certain location. When I first heard that, I thought of redlining and steering, because if you're unfamiliar, minority communities in the past were only approved for certain loans in certain areas. And if that home was outside of a certain area, you would not even be considered for a home loan for that property. So when I first heard this program, it conjured up those feelings, and I encourage anybody and everyone to read The Color of Money and The Color of Law. It gives a complete, not a complete, but it gives a very thorough, both of those books give a very thorough breakdown of the monetary system in our society and how the laws were structured in a historical context and how it plays a role in today's society. They're by two different authors, The Color of Money and The Color of Law. I highly encourage everyone to pick it up and read it. The other con regarding this program, I was thinking of, man, this is only going to drive up purchase prices in those communities. Now, if you did not know, the housing market has started to slow down just a little bit. And in some areas, it slowed down significantly. In the Charlotte area, home purchases are down almost 25%. But this program right here is going to bring more buyers to the market. And when there's more buyers and not enough property or supply, that's going to raise the prices for those properties. So I'm thinking, man, this is only going to cause more people to be priced out of the market because they're going to be competing for these few amount of homes. So those were my initial thoughts and problems or challenges I saw regarding this program. But as I thought about the program more, I had a change of heart. And this is what I believe. Again, it doesn't really matter what I believe. I think you should do what's best for you and your family. But you're watching this video, right? So this is what I believe. I believe you should do what one of my old coaches told me to do. Coach Thompson always said, use the game of basketball. Do not let it use you. Meaning, allow this opportunity to open doors for you. And then once the door is open, you take advantage of every opportunity. The same applies to this program. Do not let this program use you. You use this program and allow it to open doors for you that would have otherwise been shut. Knowing full well what this program is, yes, it's saying you can only buy homes in certain locations, so it can be considered redlining or steering, but use it for your benefit. Do not let the program use you. And furthermore, one thing we know is that this program is in place, and it's not just for minority communities. This program is for homes in minority communities. So whether Blacks, Hispanics, or minorities take advantage of this program, somebody's going to take advantage of it. And Bank of America has over $15 billion dedicated to programs like this. So you might as well take advantage of it and allow yourself to get on the property ladder and lock in your housing expense, because we both know that rental rates are increasing every single year. This gives you an opportunity to buy a home, locked in your housing expense for at least a 30-year period. And that takes me back to where I was conflicted as well, because I was, again, initially totally against the program. But as I share with you just about every video, I am a huge proponent on home ownership and getting on the property ladder. And this program will be a vehicle that allows so many people to get on the property ladder and to own a home. So I felt like I would be a hypocrite if I told you, you know what, this program, don't worry about it. They're redlining, they're steering. No. Know everything taking part in this program. And if you can use it to your benefit and it will benefit you and your family situation, I believe you should capitalize on it. But as you capitalize on it, know that your interest rate is going to be higher than the normal typical interest rate. So as you move forward, I encourage you to take advantage of the program, and as soon as you can, to make a large principal payment to pay down some of the principal for the home loan so you can refinance that property and get a better interest rate. Again, use this program to get you in the property owning business and on the property ladder, and then make plans and stick to them to where you can use this program to your benefit and you're not stuck paying higher than normal interest rates. Now, I know this video was very long and I jumped around in certain areas, but I wanted to make sure that you got all the information that I received so you can be fully aware of the program. And I encourage you to share this with others, because no matter what, this money is going to be spent. And as this money is going to be spent for homes in locations that are 50% or greater minority based, Black Americans or Hispanic Americans, properties in those locations will go up in property value. And as they go up in property value, that's going to cause a lot of people that live in those locations to not be able to afford homes in the future. So it's better to get on the property ladder sooner than later while the opportunity presents itself. I'm Sir Ashley. I appreciate you rocking with me. And remember, use this program. Do not let the program use you. I'll talk to you later.